All right, we got about 3 minutes until go time. We got Hypers in the Twitch chat already checking in. He's going to get the gold medal for being the first person to break the seal on the chat. There we go. We got Neverender, Cash Money, more for. How's it going, guys? 2 minutes until we get things kicked off. Sierra, what's going on? Yeah, we did. We upgraded to Google Fiber this morning. So we are also excited for the new internet, hoping that things are going to be a lot smoother on the stream. We get a lot less of the hey, it's freezing, hey, we're lagging. I think we're gonna be good to go tonight. I'm excited for the technical capabilities of the stream that we've got going. All right, 20 seconds to go. We've got Diamond Handsies checking in the Twitch chat as well. 15 seconds to go. Can you feel the excitement building? It's, getting real electric in here right now. 10 seconds to go. All right, and that is the timer. We are going to get things going. So let me X out a notification, click this. And hello, friends. How is it going? Neverender223, getting hype. Let's go. We're going to get things kicked off. I should probably thank everyone for tuning in again on these Sunday night stock market scans that we talk about. Love it when you guys all come together, join us. We get a good little discussion going, and hopefully we come up with a little bit of a game plan that puts us in a better position financially a week from now than we are today. Alpha in the YouTube chat. What's going on? Welcome aboard. But for those of you who are coming back, thanks for coming back. And for those of you who are new, welcome. We are going to get this thing kicked off the way that we normally do by doing what I hope will be a quick weekly recap. But as you can see, we've got a lot of rows on here to talk about. So there might be a good amount of stuff that we can get going with as we go through this recap. To kind of give you a little bit of a spoiler alert, this is what we've got lined up for next week. We'll probably touch on a little bit of this in what we talk about with the weekly recap. But, to avoid droning on, let's get into it. So one thing at the top that I want to mention as far as the profit tracker is concerned, this week we added a break-even tracker over here. And I think this does a really good job helping us, conceptualize where our trades stand, what our cushions look like on a day-to-day basis throughout the week, and what we can comfortably expect to arrive at profit. If something's moving against us, we could look at this chart and say, hey, it's still above the break even. There's nothing to worry about. And as you can see, a lot of these trades last week ended up above their break even price, meaning that they made money. So obviously we're always happy to see that. And we've got our break even tracker for next week lined up. And with the workhorse DraftKings, Wish, CRISPR, and VIH trades, we've got some decent cushions as we head into the upcoming week. But we'll get to that in a minute. Let's talk about last week where we came in with a profit. Why can't I page over here as effectively as I'd like to? There we go. Where we finished things up with a profit of $5,055. And the S&P 500, the market went up. The market had a good week. But importantly, how did we do in comparison to the market? And the answer is that we kind of crushed it, right? We outperformed the S&P 500 by 1.27%, which is always a big win for us. We're always happy to see that kind of a number. Now the question is, how did we do it? And I guess pointing back to last week, we outperformed SPY. We outperformed SPY the week before that. And for those of you who have been tuning in week after week, you'll know that we've been outperforming the S&P 500 for, however many consecutive weeks between now going back to, where is it? There it is. The week of July 19th was the last time we underperformed the S&P 500. So even when times may get a little bit tougher in the market, if it seems like we're not making a ton of money and things are staying relatively flat, which, if we jump ahead to our year-to-date summary, we're making some really good money lately. But, sometimes over a 3-week period like right here, we were relatively flat. But it's okay that we're flat sometimes, keeping in mind that the market had a pretty bad month in September. But trusting the fact that if we stick to the process that we've got lined up, we stick to our strategy, we stay smart, we stay disciplined, we are going to be able to come out on top eventually. And that is exactly what happened last week, right? If we take it from the top, UWMC finally started to turn around for us. We could take a peek at the chart here really quickly. If I pull it up, UWMC. That one turned around really, really nicely. We figured there'd be some sort of support near these levels. It previously bottomed out at 625, and I think it bottomed out at around 640 this past week, where it wasn't looking great because we sold those 7.5 strike puts for $1.10, meaning that was pretty close to our break-even price. But things took a turn for the better at the end of last week as it went from 620 for whatever reason down there pre-market up to 724 at the height. Mohan in the YouTube chat, what's going on? Welcome. But point with that one is we got a little bit of value back on that, $750 of profit right there. Rocket Lab dropped about 5 cents on those 7.5 strike puts that we've been talking about, and that's despite the fact that on a weekly basis, Rocket Lab went down, right? It dropped from $14.75 to about $12.70. That's a $2 drop. That's about a 15% drop in the stock, which if we have a bullish position, you would think, if the stock drops 15% and you have a bullish position, you're probably going to lose money. But with the opportunity that we've identified here and the implied volatility starting to die out, we still were able to make $500 on that one despite it turning against us. And just another example of why we love to identify these types of opportunities and how if we consistently attack trades in this manner, we're going to come out on top. And just these two alone off the bat pulled $12.50 of profit. So we love to see that off the bat. SPIR was another one. I mean, between the first three that we have right here, we made almost $3,000. That did 60% of the damage for the week. And as we like to mention, as we'll get to as we go down this list a little bit, just putting together a lot of different base hits that come together to give you some really nice returns. We're not trying to hit home runs or grand slams on an individual trade, but when you set yourself up, when the probabilities are on your side and you've got good expected values on your trades, you're going to get some really solid results. But SPIR, that was one that we got in on the 6 strike puts a couple weeks ago for about 30 cents a piece. They had risen up to 35, so we were looking at a small loss on those. But at the end of the day, we knew that if SPIR finished above 6, we were going to hit max profit on those. And if you take a look at what happened over the last 5 days, coming into Monday, it was trading around 630. So a 30-cent cushion on something that's trading at about 630 is a decently sized cushion, right? Objectively. But if you look back at the 180-day chart, this thing has fallen off the face of the earth. It had dipped down to 580. So really anything was on the board. And that's why we were able to get as much option premium as we were from selling those puts that we did. But point being, if we go back to the 5-day chart here, during the week it dipped down, but we remained patient. It spiked back up and finished pretty much on the number Friday afternoon at 6 a share. However, we closed out a little bit early to lock in some profit, which I do not regret that at all, because if we got out for an average closing price of 9 cents on these, and at one point these were down to 5.80, meaning that they would have been worth 20 cents. So when you're entering into Wednesday of the week, looking at a trade that potentially is going to finish up around 20 cents if all that extrinsic value dries up, and then 2 days later you have the opportunity to get out for far less than that at about a 9 cent debit, we 100% are going to take that opportunity, and I don't regret that one bit. We took $1,500 of profit right there. And again, these first 3 trades, some safer, steadier trades as we categorize them, pulled about $2,800. And that's before we get in to all this week to week, these new trades that we enter into Monday, Tuesday, Wednesday, etc. So let's talk a little bit about those. And RKLY was one of those former SPACs that we had got in, really similar price action as what we saw with SPIR, where if you zoom out to the 180-day, the thing's going to fall off the face of a cliff, basically. And that's due to the PIPE share unlockup, which we talked about a little bit on our website. We've talked about it in our Discord server a bit, but where these companies, after they merge, are going to file a Form 424B3, which unlocks PIPE shares. You could look into those filings. We have a blog post about it if you want to read a little bit more about that on our website, www.hourglass-trader.com. But, in short, moral of the story here is a large chunk of the shares can be sold. That's what you see with these big red candles. That's why it drops off so steeply. But that also gives you some opportunity on some option premiums. So we sold some 7.5 strike puts, and another one where, psychologically speaking, on a day-to-day basis on this trade, it was up at 8. This was going to be max profit. You could see max profit drawn by this red line right here. And then our break-even price was 705 because we sold these 7.5 strike puts for 45 cents. So we had a 705 break-even price. And then from there, it dipped below on October 11th and October 12th to 670 at the low point, which made us a little bit nervous, right? Because that would mean we were locking in a loss. But a lot of the times when things go down, they rebound a little bit. Mean reversion is definitely an important concept in the market and one that we like to play a lot. Tay8706, glad to see you jumping in here. Welcome to the stream. And Escotha82 as well. I think I forgot to say hello. But, point being, even if things do temporarily get below our break-even price, there's no need to panic, especially if there's a decent bit of extrinsic value left on the options that we're selling. And that was the case with this. We remained patient. And, what goes down sometimes comes back up. And you might have made the case looking at, the broader picture here. Hey, this thing went from 12 to 670 in the matter of, 3-4 weeks. That's a really, really sharp drop-off. Can it keep going at this rate? And the answer is absolutely. There was nothing that was going to stop this from going any further down. That's just inherently part of the risk that we take when we enter into some of these trades. However, if a stock goes from 12 to 671, you've got to consider the flip side of that, right? What are the odds that they could bounce? A bounce from 670 back to 750 is nothing if it previously had gone from 12 to 7. So that's something we want to keep in mind. That's when we sell these options, it allows us the patience to be able to wait for that, because if it continued to go down, we would have been able to take assignment of those shares at around 750. We could have looked ahead to the option chain that is coming in November. We could have sold 750 calls and then knocked our break-even price another 70 cents down to give ourselves roughly a 640-ish break-even price, which is right around here, headed into November. Rinse and repeat, keep lowering that break-even price until one day the stock price finishes above that break-even price. But point being, even if we lost on October 15th, last Friday, it would have been a temporary loss, and we could have moved the goalposts, lowered the break-even price as we headed into November. But that didn't happen. It's always good to have that plan B in mind, but we didn't even need to use plan B because it rose back up, and we were able to lock in a profit on this one of 330 on the week. Rocket Lab is just an extension of what we had going on with this January trade. There was decent premium on the 12.5p because they did file that aforementioned 424B3 form, which had the PIPE unlock. But with some of the research that we did, we noticed that the PIPE unlock was a lower percentage of the overall outstanding shares as compared to what we'd seen with SPIR or LIDR or RKLY. So we were confident that when they had this unlock, it wasn't going to impact it as negatively as some of these other former SPACs. And we felt that the options were overpriced. We were dead on with that, and we made $350 on that one. So perfectly happy with the way that one turned out. CRISPR is one that we like to play every time it dips down a little bit. They had some data coming out on Tuesday, I think. So we exited out of these for a profit so we didn't have to take on the risk. If you take a look at the price action on CRISPR, CRSP, there's a really steep drop off. So after hours that day, it went from 102 down to 90, and we thought, okay, it's a great thing that we closed these out early. Lo and behold, the common theme with some of these that we're looking at is even though they dip, it's pretty common to see something at least temporarily jump back up, and that's what happened here. They would have finished with max profit, but when you have a 5-day trade, it's never a bad idea to take that profit on a Monday, lock that in. No one could take that $350 from us and then put that, so to speak, in the pile of profits that we pool up at the end of the week and add to get down to our net profit. So we were happy with the way we managed that one. TMC, this is one we want to talk about a little bit because I think we had a couple questions about it in the Discord server. The 3.5 strike puts we sold last week, which are offering some decent profit. Let's pull the chart up here for the last week. Decent support starting to form here at around this 360 level. It did break below that momentarily Monday, Tuesday, down to these 340 levels. But again, remembering, these things were offering so much premium that a 3.5 strike minus 26 cents of premium meant that this whole time we had a 324 break-even price, which if we zoom out on the y-axis, is indicated by this red line right here. So that trade we had, despite quote-unquote maybe being a little bit risky, because this is another one of those, if you take a look at the chart, zoom out, you're going to see a pretty steep drop-off. But knowing that a 30-40% cushion on a 3.5 strike is relatively significant, we're still entering into these with relative confidence. Now, we haven't rolled these over to the next week. I tried to get some 3-strike puts for next week for 10 cents, but I couldn't quite get a fill on those. And it looks like the 3.5 strike puts are going for about 15 cents a piece. And again, that's a 4.48% ROR, which is a massive number on a weekly basis, quite frankly. But that does come with the territory of this being a little bit riskier of a stock. And since we aren't going to be able to get the 25 cents of premium that we got last week, we would only be able to get 15. That would put your break-even price right around 335 right here for the next 5 trading days. And looking at the chart, you see a rebound off the 340 level. You see some decent support forming on Wednesday and Thursday, and even Friday a bit end of day in that 360 level. So is a 335 break-even price a decent value? I think the answer to that is yes, and especially for a 4.48% return. However, if you look at the history of the stock, the last 5 days of trading are very, very tame as compared to what we've seen over the past month, right? So there are these big red candles that you'll see every now and then. Even when we've got a little bit of a spike, we see some red candles that indicate a pullback. So at the very least, I would maybe wait for entry on these 3.5 strike puts on a little bit of a pullback towards that 3.5 number. I mean, if it's enough to put 10 cents of juice into these, I think that's an awesome fill because that sets you up with the 290 break-even price, which is even safer. But if you can get 15 to 20 on these, I think that's okay as well because you don't want to just think about step 1 like we mentioned. We want to think about step 2, step 3. Step 1 obviously is if we sell the 3.5 strike puts, they expire worthless. We take home 4.5%, and the rest is history, right? We're going to go have a good weekend on whatever profits we make off this right here. But step 2 is what happens if this thing behaves the way that it has historically, and we see it drop down below 350 or even 335 at that hypothetical break-even price. Then from there, we could turn around the next week, which, would be October 29th, but for the purpose of evaluating these on how they would look on a weekly basis, we could then sell just out of the money calls for 15 to 20 cents. And then all of a sudden, you have a trade where if I pull up my beautifully crafted system calculator right here to give a quick rundown of what this looks like in plain sight, right? We sold the 3.5 strike puts off the bat for how much? 15 cents of premium hypothetically right here. That's going to stick us at 335 basis. And then if we're assigned at the 335 basis, what the premium for the upcoming week is telling us is we can go just out of the money and get roughly 15 to 20%. And if we want to be conservative, we could call it 15 cents again. So that would stick us with a 3.2 basis in just 5 short trading days. And that 3.2 basis obviously looks a little bit better if we zoom in on the 10-day right there, maybe even the 5-day and zoom out a little bit. This is where that would stick us with come Friday if we took assignment of those and then sold those calls for the upcoming week. And again, that would also leave upside to that $4 level as well. So, I like the way that it sets up not just for this week, but for how it sets up if you had to take assignment and run the wheel. Now, this is one that, I think the disclaimer here that's super necessary is the fact that this isn't the greatest company in the world, but sometimes the company doesn't need to be incredible when the premium and the numbers are right. And I feel like this is a scenario where on a week-to-week basis, I think the numbers are right. If we pop this thing back out to a 20-day chart, we go to our studies and we're going to put the implied volatility in here because this is really what's driving the value of these options. This is what we're relying on. It has dropped off decently from what it was previously at. However, if we zoom out to the 180-day chart, it's still very elevated in the context of where it's been. Now, this isn't terribly surprising because this is one that's a former SPAC. And as we know, for those of you who have been following us, I think we say the word SPAC maybe 100 times a day. But this is one where there isn't much downside from 10 pre-merger. So that explains the lack of volatility. So really, here onward is what we want to be looking at to get an idea of where implied volatility could get back down to. And I think until it gets back down to this 1.5 level on this study right here, that the premium is still going to be pretty decent, relatively speaking. And I'm happy, at the very least, to initiate a smaller trade on it. It's not going to be one that that I might typically do where I'll allocate 6 or 7% of my portfolio to it, but maybe 2 or 3% off the bat couldn't hurt, because that 4.48% is kind of fun to play around with. And we know that if we enter into the HT wheel strategy with this and move into step 2, which is a covered strangle, that we're going to want some buying power on the sidelines to give us some flexibility in managing the position and lowering our break-even price. Because this little calculation that we did off to the side right here, that would stuck us with hypothetically that 320 break-even price, that's only if you took assignment and sold calls. If you then kept following the HT wheel strategy, which tells you to sell a covered strangle, you would then sell theoretically a 3-strike put there, which is just out of the money, which you could probably get another 15 cents for. And then your overall break-even price on the trade gets dropped down to $3.05, which is even lower. And eventually, these things are bound to bounce no matter how bad the company. Some of these either bounce or level out for a decent amount of time to give you max profit on what you're selling, or at least stay flat long enough to kill the premiums. And I think that's going to be the type of price action that we're banking on with this one. So TMC, honestly, I haven't entered into it next week yet, as you can see down here, but I do like the way that sets up, and I might try to get an order in Monday morning to see what might fill. Maybe stay patient to wait for an initial little downtick in the stock or something of that nature, but either way, I think it's a decent opportunity for us, but definitely one where a limit price is going to be your best friend, because you don't want to be chasing a market fill between 10 and 20 cents, because a 10-cent difference or even a 5-cent difference in the fill that you're getting on a stock that's trading around $3 or $4 a share is pretty significant from a percentage standpoint. So we want to take advantage of those limit orders and try to get the best possible fill that we can. So with that said, let's move a little bit further down the list to Ccxi. This is one of those IV reversion type trades. Ccxi, we can explain this super quickly, but they're a biotech stock. And while we typically like to avoid biotech stocks, there is one relatively useful piece of info with this, and it's for these IV reversion trades. And we talk about IV reversion, implied volatility, as we just looked at it with TMC. Similarly with some of these biotech companies, what goes up must come down. IV will revert back to the mean at some point in time. So what you see right here is a really big buildup in implied volatility. And theoretically, there are roughly 3 or 4 things we look for in an IV reversion trade. The first of which is a decent base that it was trading at before a big spike upwards. So we could see that roughly in the 17, 18, 19 area. And the second thing, which I kind of said when explaining the first, is we want a big upwards spike that's off of good news. And that's an important point to mention too. If we have a big spike that's just a result of a short squeeze, sometimes there might be a little bit of an opportunity there, but we would feel so much more confident if that spike is based off of good news. And why is that? The answer is because, theoretically, before the news is published, the stock is trading around 18 or 19. We can consider that to be relatively close to representing the value of the company. Now, if there's good news, which would theoretically increase the value of the company, you have reason to believe it's worth more than 18 or 19 a share, and maybe somewhere up in this range. And using that information, we'll sell puts down below that range where we think the new value is, right? So if there was a base at 18 or 19, shoots up above that, we'll sell puts at around 18 or 19, because even though it shot way up here and could come back down, we think that with the good news that was published, it's not going to be worth less than 18 or 19. And we know that when we sell puts, as long as it stays above that number, we're hitting max profit. So that's exactly what happened right here. And while we didn't enter at the peak of volatility because that occurred before the news came out, that's essentially the type of guessing that I like to avoid with biotech stocks. After the news was out and we knew that the news was good, you'll notice that the implied volatility was still relatively elevated up here at around the 1.6 level, and then kind of started to fall back down as the price leveled off here. And that is exactly what we did with Ccxi, right? We waited for that little spike. We saw the spike. We sold 20 strike puts for 20 cents a piece. And I think within a couple of days, when that implied volatility started to level back off, we were able to get out of that position for a 5-cent debit, which means that we made $150 in a couple days off that one, off a pretty stress-free trade, right? Because as long as the stock finished above 20, we were going to hit max profit, and it never really got back below the low 30s here. So that's why we like the IV reversion trades, right? We have a few different factors going for us. And, if all else fails, typically off the bat, it's a relatively easy profit as implied volatility falls back down. But again, if all else fails and it did go down 50% from here, we're still right back at where we sold the puts. And we are still in a position to make profits. So that's why we're a fan of that one. And one of those little interesting scenarios, I think I combined the word situation and scenario. Some efficiency right there in my verbiage. But one of those interesting situations or scenarios where you can use the impact that implied volatility has on options pricing to take advantage of it and make yourself some money. That's exactly what we did right there. Ccxi, this was an older position from last week that we sold at 20 cents a piece that we closed out. DNA is a call credit spread, which is a bearish position on DNA. This is one of those former SPACs. I think it's a former SPAC. I could be wrong about that. It might not be a former SPAC. I think I may be wrong about that. But point being, they had a short report come out. I think some serious allegations that a lot of the company is fraudulent. But long story short, we sold in a 10-11 call credit spread, meaning we sold a 10-strike call, bought an 11-strike call behind it. We received a 45-cent credit, but in plain English, what that means is if the stock finishes below this level come November 19th, we are going to make money. And if it finishes below 10, which is the short leg on the call spread that we sold, we're going to hit max profit. So that's the setup with this one. No matter what it does on a day-to-day basis, if it goes down below it, goes back above it, yeah, that will affect your day-to-day or week-to-week profit. But rest assured, this thing could go up to 100, and you won't have a bigger loss than if it finished right where it is today. So we're not at risk if this thing, even though we're technically short on it, the method that we used with that call credit spread means that we're not at risk of some sort of big short squeeze. And even if it goes up, goes back down, all we care about is that it finishes below this red line right here by November 19th, which we have over a month to. So whatever this thing does on a week-to-week basis, no need to worry too much about it. Just wait until November. Be patient. We're going to try to let our thesis play out on that one. Roblox, we turned some quick profit on. And then I think to wrap this up and try to get into some more relevant trades, the last thing we're going to talk about here is going to be with GWH. And GWH was kind of the big, we mentioned we hit a lot of base hits. I think GWH was the home run that we hit this week. It got us about $1,260 of profit pretty much overnight on what initially was intended to be a 1 or 2 month trade. And to talk about this one a little bit, I think this may be behind a paywall. Am I signed in? I think I'm signed in. Let's see. Try to open up our trade plan here. Please don't be behind the paywall. It is behind the paywall. But anyways, we had it laid out here. We could go to the GWH tab that we had in here. And I'm not signed in here. I think preemptively I need to do a better job at signing in. But this might be a good little segue to advertise HT Premium. If you are interested in getting alerted to every single trade that we make, and that includes entry alerts and exit alerts for pretty much everything you see right here that came together to give ourselves the $5,000 week of profit that we had, go to our website, hourglass-trader.com, click Join HT Premium. If you sign up for a 1-week subscription, it comes with a free week trial with zero financial commitment, so you could decide if it's right for you. And again, we're not in the business of trying to pressure people saying, hey, if you're in here, you need to be joining this. Look, if it's not right for you, it's not right for you. But I think with what we provide, there's a lot of value. And I think those who are part of the HT Premium program right now and in that chat room that we have, who have been receiving the alerts, the option scans, things of that nature, I think they can attest to the fact that less than $1 a day here is a fantastic investment for the value that you are getting back out of it. And what do you get back out of it? We can go into our Discord server because that's where a lot of that value comes from. Is first of all, trade plans like what we had with GWH. You'll be able to see that, so you could have pretty much replicated the $1,200 return that we came up with and understood exactly what we were going for when we did something like that. You get the premium chat room for free, or I guess not for free, but premium chat room when you join. We have a question here about, hey, did we reopen CRSP? Yes, we did, Nation. Thanks for bringing that up. But HT trades, you're getting alerted to every single entry and exit. Sometimes I'll give you a little bit of a chart, but a lot of that discussion goes on to the premium chat. Again, the trade plans like what we have with GWH, where we lay out what we were looking at, what we were thinking, and different potential outcomes. We have a watch list, which hadn't been updated in a while, quite frankly, because I've been a little bit busy, but I started updating it a little bit this afternoon, so we should have a fresh look at that watch list. And then we have some links to some option scanners, which I'm actually going to be updating the website to reflect as well. But that's all. Again, you could sign up for a 1-week free trial if you are coming. And that is, if you want a free month as well, you could do that by signing up for a Webull account and depositing $100, sending us proof of deposit, and that'll get you set up that way. But that's what we got. That's our little spiel. We are never going to pressure anyone to join, and we are not going to inundate you with self-promotion. So let's get back to the discussion with GWH. Todd in the YouTube chat asking, can you post what we made for the week in the HT trades channel, like what we actually banked? And I think if you go to the Discord server, we do share our performance on a week-to-week basis in the free channel, right? If you're not in our Discord server, definitely join the Discord server because we give out a free trade every single week, but we give out alerts to every single trade in the premium section. And these are how the trades, the last 4 trade alerts have gone. They've paid out $550, so that's enough to pay for 2 full years of HT premium. So not saying, but just saying. But what we do at the end of each week is we do post the results of what we've done. And while these might not necessarily all be what we banked, if they're highlighted yellow, they're still open, and we're going to be rolling them into the following week. The ones that are not highlighted yellow are the ones that we've closed out of, so quote unquote, we've banked the profits on those. So hopefully that answers your question there, Todd. There we go. Let's get back to the discussion with GWH. So what we saw with this one, which you guys, it might be very relevant with this discussion of IV reversion that we just had, is this was formerly a SPAC. They had their reverse merger to take this company public. And as you can see right here, they went from $8.40 pre-merger up to almost $30 a share pre-merger. And one of the things that I think is so helpful as far as trading is experience and understanding different setups. You might see something and say, hey, that reminds me of this. This is what we did with that. Because more often than not, you'll find that history repeats itself fairly often. So GWH reminded us a lot of IRNT. And if we take a look at IRNT, there you go, former SPAC, dipped down a little bit to that 9-ish level before merger, had the merger, and then ran up to 30, 40, 50, 60 at the peak. So it was a little bit more severe of an increase than GWH, but the same idea where it was a SPAC underwent a reverse merger. There was a low amount of shares on the float due to redemption, and that's a little bit of an intricacy with SPACs that we could talk about at another time. But long story short, the way that merger worked, a lot of investors just wanted their money back, which is an option with SPACs. So they were given $10 per share that they owned, meaning that those who didn't take that option were really the only outstanding shares. And as you've seen lately, I'm sure, on social media and Twitter and things like that, when there's a low amount of outstanding shares, a lot of people, cough, Atlas traders, FinTwit, people like that who I've kind of got a little bit of beef with because I don't think they have traders' interests in their best idea. But moral of the story is that people like that will attempt to go and pump these stocks that have low floats or low outstanding shares, and that's pretty much exactly what happened with this. It's what's happening with GWH. But at the end of the day, these things aren't going to be hanging up there forever. Let me try that again. GWH. There we go. And that's what we started to see, right? When it got up here and then it started to fall back down. But one thing that was great about this jump, as we can see from the blue line that we've been looking at all night, is there was a pretty sharp increase in implied volatility as it got up to around this 2 level. And has since fallen back down because, as we talked about earlier, what goes up must come down with implied volatility. Can it keep going higher? Absolutely. But at the end of the day, it's going to fall back down. So what we were able to do with that was our initial trade was getting in on GWH, and I should probably just go to this tab right here. Our initial trade was getting in with these 7.5 strike puts, and this is a little bit mislabeled. These 7.5 strike puts that we sold for December 17th. These were going for 52 cents a piece, and those of you know, if we sell a 7.5 strike put and we get 52 cents of premium, that's going to give us a $6.98 break-even price off the bat. So if you take a look at this stock, that 698 break-even price falls right around here, which seemed like a pretty good value proposition on a stock that was trading in the mid-20s when we entered, right? And we would just have to wait it out until December 17th, which is just 2 months away right there on the calendar. That lonely little Monday down there in December is when these would have paid out, provided that it stayed above this level. But what you'll also find so often with these is that even though they're 2 months away, this drop in implied volatility is really what's driving majority of the value in these options. So when the implied volatility drops off, the value in those options is also going to drop off. So if you take a look at the December ones that we sold, 7.5, I believe is what we sold them for. More info, TOS charts. This is the price action on those 7.5 strike puts that we sold. So we sold them at about this 60-cent-ish level right around here. And if one thing that might be interesting is if we plot this side by side with the actual chart of GWH over the last 5 days. So even as the stock started to pull back, and again, you would think that if a stock goes down, the price of puts are going to go up. And that's what's reflected by this purple line, which is the theoretical price of the option. Because in theory, if the price of a stock goes down, the price of a put will go up. What you actually see, as indicated by the red and green candles right here, the price of the option went down despite the fact that the stock was going down. And again, that is 100% due to that drop off in implied volatility that we were looking at a second ago. And that's what we like to target with these opportunities, because you could look, and we do like to go front month expiry, meaning the nearest expiry for options a lot of the time. And we did do that as well with some of the GWH. We sold some 12.5 strike puts that aren't part of this longer term trade that we look at, but I think we still pulled, the max profit of 250 of those on 250 on those as well, because they had the same idea, and the premium on these was just super overstated compared to where the stock price was, and that was a result of the implied volatility. But point being, we could have sold the nearest term expiry 12.5 strike puts for 25 cents, or because in theory that's going to decay more quickly, that 25 cents of premium. However, you could go out to December, bank on that decrease in implied volatility, and the decrease in here is actually 60 cents down to about 30 cents. So there's a 30-cent decrease on the December puts, whereas there was really only a 25-cent decrease in premium on the October puts. So something that's a little bit counterintuitive, because normally you would think that there'd be quicker, decay of premiums on the nearer term options. When you have big spikes in implied volatility like this, that's the type of activity that you'll see, which is really interesting sometimes. And that's what we were trying to take advantage of that. And then the other thing you'll notice if we go to this, that was really only the first leg that we were explaining right there, this December 7.5 strike put. Right after this, you'll see an 11/19, November 19th, 7.5 strike put as well. So question might be, what were we doing with that? And the answer is right here on this Wednesday, there was a really sharp drop from 23 to 18. And that, a $5 drop in a stock is going to kick implied volatility back up, and it's going to bring some premium back into those options. So we said, hey, we're not always going to time these perfectly. We're not always going to get into the top. So we leave some buying power on the sidelines. And with that buying power that we left on the sidelines, we entered into some November 19th 7.5 strike puts. And if we go back to GWH and take a look at the price action on those 7.5 strike puts, it might be a little bit of a spoiler right here, because you can see they're trading between 10 and 15 cents a piece. That is not what I was going for. Let's try this again. For some reason, it takes twice sometimes, but there you have it, right? You see these options trading around 40 cents a piece. The stock drops, yet still, the price of these decays by almost 60-70%, which means a big windfall for the seller of that option, which was us, which we were super happy with. But that begs the question, right? We've got two of these positions lined up that are going to hit max profit as long as the stock finishes above 7.5. And we know historically, if we take a look at the chart for GWH, which I'm going to have to bring right here really quickly again, and compare it to something like an IRNT, we know that even though there's this big initial spike, inevitably the price of the stock is probably going to fall back down. And again, looking to IRNT as an example, it was down to about $11, which is a pretty steep drop off compared to where it used to be. and a level that if it got down to, I don't know if I'd be feeling terribly confident about those 7.5 strike puts. But point being, we wanted a way to protect ourselves for when this inevitably falls back down to this 12, 13 level. And the way to do that was like we do with DNA, right? We sold a call credit spread, a bearish call credit spread, 17.5, 20 strike, meaning we sold the 17.5 strike call for more money than we bought the 20 strike call for. Behind it, we received an overall credit of $1.40 on that trade. And since we had a pretty good idea that this was going to fall back down, when it did fall back down, in just a couple short days, we were able to close these out for an 80-cent debit, which is $360 of profit. So at that point, we evaluated our position. And while initially we wanted to hold these almost till expiry, right? Because if you held these to expiry, this finished worthless, this finished worthless, this finished worthless. You had this little sweet spot in the middle where if it finished between 7.5 for max profit on the puts and below 17.5 for max profit on the bearish credit spread, you hit a $4,000 profit. But again, this was going to be over an 8-week period. So we were actually at a point, because we figured the price would pull back, where this is the profit profile that we were looking at. So when you compare making pretty much $1,000 overnight to making $4,000 non-guaranteed in 8 weeks, that's where it's probably your cue to take that 25% of your max profit, lock it in, and move on to the next one. So that's what would happen with that one. We used the experience that we had with IRNT, the experience that we've seen with a lot of these other SPACs that we've looked at and studied, to have a good idea of what happens to the IV when things shoot up like this. So we knew when to enter onto those puts. We knew when to exit because the implied volatility was going to pull back and we were going to make money on those. And we also knew to enter into this hedge right here because, as we saw with IRNT and some other ones that we haven't really taken a look at yet on the stream, we knew it was going to be coming back down at some point in the future. So going with that November 19th expiry gave us a good cushion as far as time window is concerned and a good cushion as far as that 17.5 short strike for a profit target. And then the expected price action happened a lot quicker than we thought it would. And we found ourselves in a position where we were able to take $1,000 profit. That's what we did. And I think that is what I would have to say was my favorite trade on the week. And I know some of you guys who are watching got in on that one with us as well. So we always like to see it when not just we win, but when everyone else is winning with us, because it's always fun to win in a group, right? One person can win. And the great part about our strategy is the fact that there's always going to be people buying options, right? If you look at the volume for these, there's thousands of these traded for every single strike. So there's always going to be people out there buying options, and us entering into a trade and getting it out there and pushing the idea out to you guys and spitballing a little bit and brainstorming about what we could come up with for different strikes and opportunities. Us getting into that and you getting into that doesn't negate the opportunity for one another, and we could just win together. And I think we've done a pretty good job of that so far, which is, another reason I've really enjoyed the community aspect that we've got going in our Discord. I think we got a really solid thing going. We're making money together. And now that kind of begs the question, how are we going to continue making money together? Because, profits in the past are great knowledge to you, and it's good to look backwards and learn from what we've done. And we've talked a little bit about what's going on in the upcoming week, but let's get a little bit further into what's going on in the upcoming week. So this is probably the shortest little list that we've had as far as trades that we are holding heading into the upcoming week. For those of you who are familiar with what we do and have been following along, you'll notice that the lists at the beginning of the week are typically a little on the shorter side, but I think this is the single smallest list that we've had in a good while, right? We're only using about 34.51% of our buying power, and a great time to remind everyone that, cash is a position too. And if you look at SPY, the S&P 500 index, we're in a situation where we're ripping back upwards after things have been pretty shaky since the start of September. So I don't entirely trust this, looks like completely green candle rebound here, almost too good to be true, right? If we zoom back out to that 180-day chart and bring up our old buddy RSI as the study under the chart, if I can get down to the R's and find it. There you go. You'll see we're at a 72 reading right here on the 180-day RSI. And what does that mean? If it's above 70, that means it's overbought, and we're likely going to see a little bit of a pullback, short-term correction. And if it's oversold, we're probably going to see a little bit of a bounce. And we like to do this thing where we historically look at how this has played out. Here's one where we would expect to see a bounce. You follow that line upwards, we saw a bounce. here's one where you would expect to see a little bit of a pullback at a similar level to what we saw the S&P 500 at the end of this week, and it leveled off a bit before falling back down. Another time when it got back into the red here was back on August 13th, and then you see a subsequent drop-off. Red right here again on July 2nd, subsequent drop-off, but you get the idea. And to maybe cut ahead in our preview of what we got for the upcoming week, we sold some call spreads on SPX to play that idea of the fact that, hey, RSI is a little bit elevated on the 180 day. Historically, when RSI has gotten into this level, we love RSI as an indicator, but when it's gotten to this level, we've seen some sort of short-term pullback, or at the very least, a leveling off before some sort of pullback to get it back down below this yellow line, below 70, and more into a fairly traded territory. So to protect ourselves against a little bit further of a jump, right, on SPX, we sold a 45.10, and let me make sure we get the numbers right here. Yeah, 45.10, 45.15 call spread. What that means, if we zoom in on the 10-day here, is that we just wanted, if I remove this line, as long as SPX stays below this number right here, 45.10, we are going to hit max profit on this trade, and max profit on this trade is going to be a solid $690 on us. So that'll be a nice little, shot in the arm to get our week going right here. It always takes one or two decent ones to get you going on a really nice week. We had some good ones last week when we pulled $5,000, but I think this is really nice right here. And one thing to note about this one is typically we go a week out, but we went with October 30th, which is Wednesday expiry for this upcoming week. So basically, as long as SPX doesn't go up about 0.85% over the next 3 trading days, this is going to hit that max profit. So not only are we playing it back down, but we're also simply just playing it not to keep ripping upwards, right? If RSI could go back down below on the 180 day, I think we'll be looking pretty nice. And one other thing we like to look at is areas of support and resistance. If we extend this out to the left, admittedly, we did not do the greatest job of plotting this on support and resistance, but I put our strike where it matched up with this big candle back that we had on August 27th, because I think that could represent a little bit of a gap fill. But as far as entry, I was patient until we got to around this 448 level, because we could see if we extend that 448 level out, we have some resistance right there, resistance right here, and I expected us to run into resistance right around this level again. And we came pretty close as the top part of this wick got around here before they dropped back down. And if you take a look at futures, they're down 0.07%, which is, quite frankly, at almost 10 o'clock Eastern time, kind of useless at this point. But whatever, we'll take any minor red that we can get. Sometimes a flat week is the best week for us, right? Because we put ourselves in trades where as long as they stay flat or above our break-even price, we're going to hit max profit. So if the market runs away, we don't really care. If the market stays flat, we're perfectly happy, because that is going to get us the profit we want and make it more likely that we outperform, which is the ultimate goal for what we're going for in here. So with that said, that is one of the trades that we currently have set up for the upcoming week. And let me put this back to 1.15 so I'm not totally skewing the profit. And one other thing that I do want to point out is, how are we evaluating these trades that we're in for the upcoming week? How do we know when we have a sufficient amount of trades to just sit back and let ride and try to make some money on? And the way that I do that, and the reason I've started highlighting some of these blue, is I look towards the weekly options, right? So this is expiring Wednesday. These 4 right here are expiring Friday. If this expires worthless, this expires, this expires, this expires, and this expires worthless, that's a 1.1% return. And I think that's a decent starting point. I think ideally I'd like to be closer to the 1.5 or 2% return at max profit on the weekly trades. And again, we're using 34% of our buying power, so I'm definitely going to be planning on scaling in to some more for the upcoming week. But that is what we're currently sitting at as far as portfolio sizing is concerned. But Workhorse, if we take a look at that one, we sold 6 strike puts, WKHS. Let's take a look at that. 6 strike puts means our max profit point is right here. We sold these for 16 cents a piece, I think. Let me take a look back. 16 cents a piece, meaning we got a 584 break-even price on these. So max profit, break-even price a little bit lower than that. It closed at 650. Nice little rebound, because I think it did start to cut it a little bit close. Really not even, right? It went to 640, bounced right back up. So we've got some decent breathing room for the next 5 days, and looking 5 days backwards is normally a pretty good idea of where you can expect things going in the short term. So that's what we've got set up right there. I'm happy with that one. If that finishes where we want it to finish, we're going to be making $240 on that one. Next is DraftKings 47 strike puts, and these are cutting it a little bit closer. We tried to be sneaky and get in on these before the end of last week. We probably should have waited a little bit because it did not have the best Friday in the world. But again, we sold 47 strike puts for 55 cents a piece. We know that means our break price is going to be around 46.45, which is right here. So even though a little bit of our cushion evaporated on Friday and we've got a little bit of an unrealized loss at the moment, we can rest assured knowing that as long as DraftKings finishes above 46.45, we're going to make money in the upcoming week, and that one's a little bit larger of a position for us. So if those expire worthless, that is going to represent a $333 profit. Again, just as long as DraftKings finishes above 47, which we're going to draw this red line right here. And you might be wondering, well, what's the third red line? And that is where we plotted out support for DraftKings, right? So you see it bounce off it here once back on October 11th, another bounce off of this level October 1st, a bounce off this level back on August 4th. So really 3 opportunities in the last 2 months for DraftKings to break below this level, and it hasn't. So it's acted as a very, very nice level of support. And so I'm happy to play a strike. So we perceive support to be at 47.50 roughly. So by selling the 47 strike puts, we think that not only do we have the nice cushion between the current stock price and 47, we also have this additional bit of defense right here with this 47.5 strike support, which we think should offer some sort of short-term relief to the point where we could get away with the next 5 trading days surviving above this level. But one of those things, we'll sit back, we'll wait, and we'll see. And even if we get assigned on these, I'm perfectly happy to take assignment with the 46.4 basis, because if you look at the weekly premiums on these things, you can get about $1 per week at some decent levels. And appreciate the sub, Nicholas. Shout out to the new subscriber. Always love giving those notifications. But even if we get a 46.4 basis, again, point being, we could sell covered calls for about $1 a piece just out of the money, meaning that the week after it would be 45.4. And again, we just keep marching the break-even price down until we get to a point where our break-even price gets below where the stock price is. And a lot of precedent for this thing to run back up into the 50s, 60s, and maybe even 70s if it starts ripping. But point in all that being, looking at this 180-day chart, is I'm perfectly happy to get in at this mid-40s level as far as a break-even price is concerned. And that's why we've got that labeled as a safer trade. Going back to a premium chasing type trade right here, we've got Wish, which we sold 5 strike puts, and I think we've pretty much made money on this thing all the way down. It has not been a very strong stock. It was one, back to my little rant about people on FinTwit and Twitter trying to pump stocks. This thing has been running down ever since some people on Twitter convinced people it was going to 40 or 50 bucks a share, but it's fallen back down. And thanks to the premium from these insane candles and these insane moves along the way, we've been able to collect a decent bit of premium. And I think every single put that we've sold on Wish has resulted in profit over this period right here. And that's remembering the fact that this was a bullish trade. So every single bullish trade that we've entered right here has made money despite a strong downtrend. But point being is every time it gets back near this $5 a share level, we see a little bit of a bounce. There was a little bit of shakiness back on October 6th when it dropped down to 460, but it quickly rebounded back above that 5 level. It loves hanging out above this 495 level, so I wouldn't be surprised if it was pushing it all week and it made us play this thing down to the wire. But point being, at the end of the day, we started this with a little bit smaller of a position. So if we have to take assignment, it's going to be at a 48 basis. And due to the tendency of this thing to kind of jump up sometimes, there's decent at the money call premium, about 20 cents a piece. So if we get assigned at 480, we could sell 5 strike calls the next week theoretically to get us down to about 460, and then enter into a strangle where we could get even more premium and get us down to about a 450 break even price is where I anticipate we'll be at if we have to launch into an HT wheel covered strangle right here. But that's where I anticipate we can get our break even price to come Friday if these 2 levels break. But that is a bridge we will cross when we get to it, and hopefully it's a bridge we never will have to cross. So again, if that stays above 5, we sold these for 16 cents a piece. that's going to be $240 of profit right there. So again, the idea is diversity in our portfolio, just stacking up base hit, base hit, base hit with all these high probability trades where if they keep hitting and keep hitting, these things start compounding into really nice gains. And even though this is a really short list of trades, we are 100% going to be opening a ton of new ones this upcoming week, I'm sure, because there's opportunity every single day in the market. We can only have so much of a plan going in on Sunday nights. But again, to close the loop on this, CRSP is the other one that we have for the upcoming week. 93 strike put. Remember, we had the 95s for last week where we closed out for profit early. But we're going back in with the 93 strike put for $1.17 a premium. And I think these are looking pretty good too from a break-even price perspective. Why did we pick the strike of 93 that we did? Answer was there was decent premium. And after that bad news that they had on the trial, it bounced very, very hard off this 92-ish level right here. So 93 strike is our max profit point. We got about $1.10 a premium, meaning that 91.90 is going to be our break-even price. So again, two numbers that I am very happy with for the upcoming week as far as a max profit and a break-even price. So that's what we're doing with CRISPR right there. We are at about an hour in the stream. So if you guys have any questions about stocks that you want to take a peek at, feel free to throw them in the chat. But I think a lot of our analysis this week, interestingly enough, is earnings season is finally going to be back. So let's pull up the calendar here really quickly and talk about a general game plan of what we might be looking at as far as earnings are concerned for the upcoming week. So there we go. A lot of big names coming up right here. We got Netflix, we got United, Johnson & Johnson, Procter & Gamble, Verizon, Tesla, AT&T, Snapchat, Chipotle, Intel, yada, 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 yada. So in general, what we like to do with earnings, we could do iron condors if you want to play it between two numbers, but we typically look at the expected move for something. And on TD Ameritrade's Thinkorswim right here, for example, with Netflix, we could see if we go to the trade tab, there's an expected $32 move right here. So you would take that number, subtract it, and add it to the stock price to get an expected range that the stock would trade in. And then the idea is that you plot that range on the chart. So it would be like $600 and then $660 for 30 on the upside. Extend these both to the left. And this is just very back of the envelope map here for demonstration purposes. But if you go back to the 180-day chart, this is the expected range based on the way that the options are priced for earnings. So with that in mind, what we like to do after that is see if these line up with any areas of support and resistance. And this is run far above what it has previously traded at over the last 180 days. So this is the type of stock that we would typically avoid with this earnings analysis. But point being, if you did want to enter into a trade on this via option selling, the way to do it is by selling it on the outside of this expected move. And more often than not, you'll find that it stays within this expected move and you find yourself with some really nice profit. I think one example we could look back at was Nike when we plotted their post-earnings expected move. And that was right around here. They had earnings and it dropped pretty much to 150 on the number. So if you sold anything outside on 170, obviously those calls would hit max profit. But again, if you use that concept of an expected move and sold below 150 if you were selling puts, those also would have hit max profit. And then above all else, if you were just patient, even though it went back down, it came back up. And that is the game we play, right? And when we sell options, we can continue to roll that position in week after week after week after week. The person who bought our option really only has until expiry to make or break their position. So we have the luxury of time. We can move the goalposts. We can move our break-even price further down. We can move our expiries further out. And that's just the game that we play. So even if you panicked after earnings and you did sell where you were supposed to sell based off that expected move and then freaked out when it went down to 145, just rest assured knowing if you're investing in solid companies, particularly for these earnings trades, that's what we like to target. If you're patient enough, it'll probably come back up. Again, looking at that concept of RSI that we love to talk about so much, when it got back down to the blue right here, it ran right back up almost immediately after. So that's why we like to use RSI so much as an indicator. And then this is, again, just a high-level example of what this earnings analysis looks like. And when we plotted it on Netflix, that is what it looks like. And again, ideally, outside of just the expected move, I mentioned the fact that Netflix looked like it had been running away a little bit, so I didn't really want to play it. I like to find stocks where on the 180-day or even just the 20-day,
it's trading kind of in the middle of the range. That's a situation you'll get into when you'll find that these will start to line up with areas of support and resistance. And then you could use not only one, that concept of an expected move, but two, your second line of defense to rely on is that you're selling below a level of support or above a level of resistance. And then if you have those two things working for you, you're even more likely to hit a profitable trade. And that's a great way to play earnings. And I think I might use a decent bit of my buying power to start getting into some more of those earnings trades for the upcoming week. Now that we're finally back in full swing, I think over the past couple weeks, it's been a very barren menu for what has been up on the earnings calendars. So we're excited to get back in here. But to the point about what we typically like to do, I actually only like to look at Wednesday after close and beyond. Because not only when you announce earnings, and I guess we could use Nike as another decent example here, they have this implied volatility drop off, and that's where a lot of the value in option selling around earnings comes from. So if we pull up our IV study again, you'll see here's earnings, and then right after earnings, implied volatility kind of drops off the face of the earth. Here's earnings, not dropping off the face of the earth because there's an enormous move, but it does decrease a little bit. Another earnings event right here where afterwards implied volatility falls right back down. And as we know with implied volatility, when it falls back down, we are going to be making money because the price of the options is going to decrease. But the idea is that, one, we play earnings because of that implied volatility drop. But two, when we sell options, we like theta decay. And when is theta decay the most rapid? And it's right before expiry. So that's why I like to sell Wednesday afternoon and after for these earnings, because then you get into a position where not only, one, are you taking advantage of the severe drop off in implied volatility, two, you're also taking advantage of the theta decay. So we start to put all of these factors together where, one, we're using the concept of the expected move to plot where the earnings might be. Two, we're using the concept of implied volatility for having that big drop off in the price of the options. Three, we're using areas of support and resistance to give us a second line of defense to protect against certain price movements. And then four, we're waiting till the end of the week to sell some of these for some of these earnings Wednesday after close and later, to have theta decay working in our favor as well. And if we have all of these factors between using the expected move, using theta decay, using the drop off in implied volatility, and then using support and resistance for selling our strikes, we put ourselves in some positions that are successful far more often than they are not. And that is what we go for with earnings. So when I'm looking at this calendar, I'm really only looking at Wednesday after close and beyond, where we see Tesla, we're going to see AT&T, we see Snapchat, Intel, Chipotle. I think those are some of the bigger names. And now with this earnings analysis and the expected move analysis, right, it's based off of the current price. Now we know that that current price is going to be different come Wednesday afternoon, so I like to hold off until about Tuesday afternoon to do our earnings analysis for the week. And I'm going to plan on doing that again on our website if we hop back over to Hourglass Trader. I haven't done it in a while. I've been a little bit busy. But I think if you go back to get an idea of what we're going to be posting as far as this analysis is concerned. Here we go. I guess it's been a while. It's definitely been a little while since I did it, but we'll find it. Bear with me as I scroll through here. Here we go, an earnings primer. So this is going to be what we're looking for here, right? We're going to give you some information about historical earnings moves. We're going to give you that current price, the implied move, the expected range. And then we're going to plot that expected range for you. For all of these different stocks that have earnings upcoming, right? And then I think I'll try to add a little bit of a blurb about what we're looking at for these. And again, this is decently useful information, right? If we look back at something like, I don't know, if we look at Peloton back when they had their earnings, I think we plotted this range right here for the expected move. And if we look at Peloton, PTON, and scroll back to when those earnings were back in August, there you go. You'll find that right after the earnings, it pretty much dropped right on this number right here, and you would have made money by following that concept of the implied move. And Sleepy Condor, I am not ready to be quizzed right now. Sleepy Condor is one of the for those of you who don't know, he's one of the big ballers of our Discord server, and he is applying for portfolio margin because he is such a big baller. But as a result, he has to take an options test to prove to everyone at the brokerage that he knows what's going on. So for his sake, I hope he knows what's going on. I think we toyed with the idea of doing that live on the stream, but he might be on his own for that one. But going back to the idea of these expected moves, when you look back historically, they're very, very accurate. Dollar General was another one that we plotted. DG, if we go back to that move back in August, right after earnings, it fell pretty much, back onto that level that we had right there. And if you go look at another one, like, I don't know, Snowflake, what was at the top? Salesforce CRM. I don't know what happened with this one, but we can take a look back and see if it worked as well. And the answer is right after those earnings, check it out. It ran right up to the upper bounds of that expected range and then fell back down. So this is what we are going for with these earnings trades. But again, we like to focus on Wednesday afternoon and beyond. So just that we have Theta Decay as an additional supporter of our strategy. That was probably a weird way to word that, but so we have Theta Decay working for us as well. It's getting to that time of night where I start to lose some words. But Tesla is going to be one on the radar. I'm not a huge fan of that, so I might use a spread because I don't want to own it. AT&T I think is going to be a great one for this. Snapchat as well. Chipotle, American Express, but expect one of these to be published on our website at some point. So you could sign up for our website. There's a free way to sign up for our website where you'll get email notifications for when things like this are posted, where you don't have to actually sign up for premium or anything like that. But that's something to be on the lookout for this upcoming week. We've got one question. Here we go. Todd asking about BWEN at 340, saying he got that. What is BWEN? Broadwind. And, first thoughts right here, first impressions. Obviously not a great 180 days. Big downtrend, but the flip side of that is the price you're getting at right here is probably a great entry price. Let's take a look at the options. What I don't like about the options right here is, one, that they're only monthly options, so there's not a bunch of flexibility in rolling these things around to different strikes, different dates, and there's $2.50 intervals in here, right? So if you sell a 2.5 strike put and the thing starts to fall, what is your recourse, right? You don't really have a 2-strike call. You don't have a 1.5 strike put you could sell or anything like that. A good example of what we're looking for, funny enough, is Ccxi is one of these where they have weekly options. They have 50-cent intervals, so there's a lot of flexibility around what you can and can't sell. TMC is the exact same way, 50-cent intervals. You have them every single week. So if it does fall, you could choose what puts you may want to sell to double down in the position. You could choose how aggressive or conservative you might want to be when you sell calls, when you're picking your strikes. But for BWN, I don't really see that same type of flexibility, and that's something that kind of scares me, on top of the fact that not a ton of volume right here, so it's going to be tough to manage that trade. This is one I would probably stay away from an option selling perspective, unless you had shares that you were trying to cover with covered calls, because I think covered calls are something you could pull off. The cash secured puts might be a little bit tougher. And to that point about expected moves, we have Thinkorswim telling us that there's a $1.45 expected move. So I don't know exactly what this company is, but there must be something pretty big coming in the upcoming month for there to be a roughly 50% expected move in the price of the stock over the next 4 or 5 weeks. So that's something I would, one, be careful with, but two, I'm just not the biggest fan of from an option selling perspective, especially when you look back to just October 6th, just a week ago, was trading back down around these levels. So maybe wait till it gets closer to 2.5 if you want to sell something on it, but for where it's trading at right now at 312, I wouldn't touch personally those 2.5 strike puts. But yeah, going here, that's what we've got for the upcoming week. A really short list because, as we mentioned, the market's been ripping up. There hasn't been a lot of opportunity for entry over the past few days of last week. We like to enter into bullish trades on red days in the market. Those are the best entries, and if you're having a string of green days, it's okay to be patient because, again, cash is a position too. However, when the last 3 days in the market have just been the market ripping upwards, you're not going to have a lot of great entries. And that just comes with the territory, right? We don't want to get crazy, blow all of our buying power, put ourselves in a position just to be in a position. We're going to hold some buying power back, and we're holding a pretty significant amount of buying power back right now. We're only using 34.5% of our current available buying power. But, beyond that, we're going to wait for some sort of dip. The market's not going to be green every single day of the week, right? When we looked at the 180-day RSI, we were expecting a little bit of a pullback. If we show that again really quickly, we're expecting a little bit of a pullback in the market maybe over the next day or two. And again, that's why we sold the SPX vertical call credit spreads, the bearish position on SPX, because we think that we're going to see some sort of minor leveling off or pullback. And then hopefully over the next few days, the way that the week will develop will be a nice pullback Monday, Tuesday, where we post max profit on these. These might take a small hit, but again, we have cushions built into these trades, which is why we trade the way that we do. Because, no one knows if a stock is going to go up or down. That is just a complete fact of investing. Everyone who is out there is guessing. And now you can make educated guesses, but at the end of the day, you're guessing. So we love the strategy that we run because we could guess, but we want to give ourselves a cushion in case we're wrong and put ourselves in a position where over 50% of the time, the trades that we're making are going to be hitting max profit. So that is what we've got ourselves set up with for the upcoming week. We're hoping to see a little bit of a pullback. Not a ton of great entries at the end of last week, so we don't have a ton to give to you as far as things for the upcoming week. If we could pull our scan in here really quickly, see if we see anything interesting. High return on risk without earnings. Let's see what this pulls up for us really quickly. And some big names right here, but BBIG, OCGN. This is one that's been pumped up. OCGN is one that is a biotech stock, so we're going to try to stay away from that one. MNKD, same deal. FOSL, I don't really know what that is. We could take a look at that really quickly. FOSL, if I had to guess, it would probably a former SPAC type stock right here. But this is what's going on right here. All the bids are at 0. The ask is whatever, so they're putting these at just the midpoint. So this isn't really a realistic depiction of what this is going for. So that's kind of just a bad result on the scan. BTBT is a crypto stock. I'm staying away from those for now because crypto has been on a massive run. If you look at something like MARA, and the group may or may not like this, but as big of a run-up as this has had, which we've seen run-ups like this in the past, it's great for everyone who's holding on to these. I'm glad that we've had people in the group taking advantage of this, but have to believe this kind of thing is going to cool off at some point in the near future. And that's not to say it can pull, or I guess not to say it won't pull back to 45 and then start ripping right back up onto 60, but when we trade week to week a lot of the time. When we try to guess short-term price action, this is typically relatively an area that you would see a little bit of a cool off before resuming an increase. So there we go. We've already got a couple comments telling me that any gang won't stop. More4 is already laughing at me, but hey, all right. Sorry to rain on the parade of the crypto gang, but I don't like to watch people lose money. I would just caution you, if you are someone who has had a really nice windfall from the performance of crypto lately, that this is a time when you should start cutting, taking positions down, taking profits, taking money off the table. And then when we see something like this, where there's a huge red day on the stock and everyone's like, oh, what happened? All those profits that you took, that's when you could cycle that back in. You'll have a lower basis and then just sit back and wait from there. I think that's the way to handle that. But with that said, for how much we discussed it, I figure I might throw a little bit of a tidbit saying that, maybe not the greatest thing to sell puts on right now. I wouldn't want a bullish position on this kind of a setup. But back to the scan, nothing too crazy. A lot of these are super, super, super risky. Space is an interesting one. SPCE, Virgin Galactic, Richard Branson's space tourism company. Huge red candle here because at the end of last week, they announced that they were pushing back their type of revenue that they expected to receive, or I guess pushing back when they expected to receive their first revenue, I should say, until Q4 2020, which is interesting because you see a 20% haircut basically in the value of the stock, but it's not them saying, hey, we're not going to make revenue at all. They're just pushing the time frame a little back. So I think there's still some decent-ish value in the company. But again, looking to the left, looking backwards on the chart to figure out where we think a good entry might be, this 16-ish level right here, which started to stall out back in May earlier this year off the initial dip, I think that might be a better level to start selling at. So whenever the 15 strike puts start getting some more premium than they currently have, or if you want to go a month out and take 2.6 or 3.9% on a month trade, that's something that's not a terrible idea, but that's more in line with the level that we would like to be getting at on this one. So something we want to keep an eye on in case it keeps falling back, but we never want to get stuck in a bad trade. I'd much rather miss out on a good trade than be stuck in a bad trade. At this level, I think it still could become a bad trade, but let's be patient. Let's let it fall back to us. And as we wrap this stream up, we're going to take a look at LOGI because that's what Diamond Handsies wants to see. and talk about a pullback right here. This is just the 180-day chart. And, you know, I would go so far as to say this looks a little bit like the MARA rip that we're seeing. And look what happened. I don't know. Just saying. But with Logitech, obviously a ton of volatility in what we're seeing over the last 180 days as far as RSI is concerned. Right around the midpoint at 44. And again, let's take a look at the most important thing that we got right here, our buddy implied volatility. How's that looking? It's a little bit elevated right here. I would assume they have earnings coming up because it looks like they had them in April, had them in July, which would put the next in October at some point. So if we type in LOGI, it's going to tell us they have earnings on October 25th. So that is not this upcoming week, but next Monday. Do they have weekly options? The answer is no. So if you're going to sell an option, just know that this is within the upcoming earnings window. TD Ameritrade is telling you there's only a 5.9% market maker move. And again, this is slightly different from the implied move based on the implied volatility and pricing of the option chain, right? So this is implied volatility of the option chain, which implies about an 8.74% move, whereas the market maker move, which TD Ameritrade claims is a proprietary formula used by market makers to help predict the move in a stock. This is a lot less than what's going on right here, which is good because when realized volatility is less than implied volatility, that's an advantage for people who sell options, and that's what this is suggesting. So anytime you see a yellow number right here that's significantly smaller than the number implied by the volatility in the option chain, that's normally a pretty good opportunity for option sellers. So there might be a way to actually look into that and filter a list of the market maker move versus the implied volatility move. That might be something to look into. I might make a note of that and see what we can see. But with that in mind, looks like you could sell roughly an 85 strike put for 3% over the next month, which is probably around the range that I would want to look for as far as a return is concerned. But being cautious about the fact that these are pretty much right up. They're the next one below the money right now. So selling an 85 strike put for about 275 will put you at about 82.25, which is represented by this right here. We're going to extend that out to the left, and that is a price point that Logitech has not seen in the past 180 days. So let's zoom out a little further. How about in the past year? And the answer is yes. We saw this level briefly back in November of 2020, and this looks like a good level to sell it at, quite frankly. And while 3.3% isn't a groundbreaking return, it's a return that has a greater than 50% chance of profit if we put the option theoretical, the probability this finishes out of the money, meaning probability hits max profit. There's a 58.96% chance that you are going to be hitting max profit on this. And beyond that, there's a 75.5% chance it finishes above 80, meaning you're probably going to have the stock finish in a manageable range. And we use that concept of previous support that we see from back in November where it bottomed out at about 80. It did slightly dip below for literally 2 days here before it jumped back upwards. But at least in the short term for the next 4 or 5 weeks, I think this might be a decent opportunity. But what I would say is with earnings next Monday right here and the expiry of the option right here, maybe wait until Friday. There's a lot of time between now and November 19th. So a lot could happen between now and then. And I think that's some advice that applies to pretty much everything that has an option chain that looks like this, where you have only monthlies. And that's an area where there is a decent bit of opportunity, and when we've been playing those lately, like SPIR had only monthlies. If we take a look at SPIR, we'll see the November 6 strike puts offer, if we go back to return on risk, they offer 13.21% return. Even the 5 strike puts offer a 5.82% return, which is an insane number because if you go to the 20-day chart, the 5 strike is going to be down here, a price that it's never really traded at after demonstrating decent support at 6. However, there's still 33 days till expiry. And if we're familiar with the way that Theta Decay works, it's exponential, right? So the closer you get to expiry, the more they decay. So since we're about 4 or 5 weeks till expiration on these right here, I think general advice for what we're going to be doing and how we're going to be handling these monthly trades, because even something like RKLY, another stock that we like with only monthlies, really nice returns, but you're still decently far away from expiry. So I think with how Theta Decay works, with how far away we are from expiry on some of these monthlies, I think the plan, and this applies to Logitech as well, is to wait until we get to about the 2-3 week window meaning 2 to 3 weeks till expiry. So right around November 1st is when we should start turning an eye to some of these monthly trades, because a lot of the time the premium is going to hang relatively steady until you start running near excuse me, running near expiry. And again, the decrease in value based off theta decay is exponential, so it's only going to get better. This week is going to be better than this week. The first week in November is going to be even better than next week, and so forth. So I think that 2 to 3 week window is exactly where we are going to be going for. But to Sleepy Condor's point, this is a little bit of a theta and Vega type trade, but the monthlies do love Vega. And that's what we demonstrated when we had GWH and we sold those December 7.5 strike puts. And Vega is the Greek for implied volatility. And when we saw this implied volatility, high Vega means that as implied volatility drops off the face of the earth, those value in the options is also going to decrease pretty sharply. So Vega is something that we kind of ignore, that 2 to 3 week rule for the monthlies, because when this drops off really sharply, you'll see that if we look at the price of the 7.5 strike puts right here, they also dropped off really sharply, and we had a really nice opportunity to make money off that. So if we're making a Vega or volatility IV reversion type trade, ignore that advice. But if we're running more of an HT wheel type approach on something where we potentially are considering taking assignment and then rolling down and managing as such as the process dictates, that's when we're going to want to wait till the 2 to 3 week till expiry window. That is for selling those. We get a question from Hypers asking, what do I think of the P50 strategy that Tastyworks has? It's the probability which you will make 50% of the total premium. It runs a Monte Carlo simulation a ton of times and stuff. To be completely honest, I'm not terribly familiar with that, so I'm not going to speak live on it and just talk out of my ass. So I'll look a little bit into that. Sounds interesting, and hopefully we could revisit that either in the Discord server at some point this week or on the stream next week. But with that said, we are an hour and 20 minutes in. This is about the point where we're going to cut it off. Again, we had an awesome week last week. We made $5,000. Looking in the context of the overall year, right? We haven't lost money a single month on the year so far. Our account balance is this really nice general up and to the right trend, and that's always something you like to see. But most importantly, the dollar figures aren't important because everyone has different account sizes. What is important is the percent returns that we're generating, because that is something that can be replicated by everyone. And this is our performance against the S&P 500 on that percent return basis. And the great part here is, as of close last week, we are at a 95.53% return. So if we have one more week like we did last week, we are going to hit 3 digits, hitting a 100% return year to date, which was a little bit of a milestone that I've had my eyes on for a little bit here. And again, the other little streak that we could try to brag about is the fact that we haven't lost money a single month on the year so far. And how have we done it? The consistent, smart, steady and profitable approach with option selling, using the strategies and mindset that we've outlined so far on the stream. And again, if you're just joining in on the back end of the stream, we kind of crushed it last week. I mean, I'm perfectly happy to talk big when we have a big week, because we're perfectly forthcoming and transparent when we have bad weeks like what we had at the end of September. But again, the good weeks are going to outnumber the bad weeks. We are going to make profit in the long run if we stick to the script here, and really independent of what the market's doing, right? The market in September had the worst month it's had since the COVID crash of 2020, yet we still made money. And same deal with upfront in January when it dropped over 1%. And that was a really weird noise I made when I was trying to come up with the word right there. But circling back here again, if you are just tuning in at the end of this and you want to figure out how you could try to, replicate or trade along with us and learn the answer, is just joining our Discord server. You could find the link to that. I think we have it in the bio of our Twitter account. It's in the description on a lot of our YouTube videos. And if you should be able to find it pretty much on all of our social medias. But beside the point there, if you want to join premium, this is how you get alerted to every single trade that we make as we make it, entries and exits for everything that you see on here as we make the trade. And it isn't a thing where, if we get in on a trade, you can't. There's plenty of room for everyone. That is That's what we're doing right here. And again, it is perfectly free beyond the premium plan, which is less than $1 a day. So some great value on there if you do choose to join that. But beyond that, perfectly free, to join the main chat room. We still give out one free trade a week. We share our performance, and we have, most importantly, all of our videos that have, instructions about the strategy, what we're looking for, how we manage different trades, the HT wheel. All of that is free to learn, and it is always going to be free to learn because the ultimate goal here is just to teach people a different strategy that they may not previously have considered before, because it is a much more consistent and long-term strategy for success in the market. And that is, I think, where we're going to cut it off. So if you are sticking with us from beginning to end, or if you're still on here, thank you so much for tuning in again at the back end of another Sunday night. We had a little bit of a suspicion that we lost money this week because I didn't sign it off with my cheesy little outro. And then once we fixed that for the next 2 weeks, we made about $7,000 back. So we are definitely going to sign it off by saying thank you again for joining us. This has been the Hourglass Trader, where as time passes, we make money. If you joined us this week, we hope to see you again next week. Tell a friend, bring someone, join our Discord server, and hopefully we will see you a week from now with more money than you have tonight. Thank you.